all the decisions of all the money in the world is reflected in this. It's simply a question of, is the money buying this?
While the market may move on headlines, many successful retail investors know there's one main trend to follow.
It's noise, ignore it. Look at the money, and the money is the chart.
Felix Prehn with the GOAT Academy is known for following the money and the action in the charts.
People often look at charts like this and they go, oh, it's too late. But it is actually the stocks that are moving up that are much more likely to keep moving up.
He shares a list of 5 stocks that institutions are buying right now.
Your volume will double or triple or quadruple, and that's institutional money pouring in.
Where following the money should take your watch list this month. Let's dive in. Felix, so great to have you on the show today. We love watching your content. I know a lot of our viewers watch both of our channels sometimes, so it's great to have another YouTube stock market channel on the show today. Felix, you are really good at following the market. You're in the market every day, just like our team here at MarketBeat, but you are all about following the money and looking at where that takes you in the market. Talk about your strategy a little bit before you get into your list for us today.
Well, first of all, Bridget, thank you so much for having me on. It's a real pleasure. And we do seem to have a lot of, I think, sort of shared viewers. So hopefully people will get a lot out of this. That's my goal here today. So my strategy is kind of a simple one. So I was a banker for a little while. I was a hedge fund strategist, and my job was to find the stocks that the sales team would basically sell to fund managers and so on. Really, it was all about, well, where is institutional money going to buy next? So it's those breakout stocks, that sweet spot you want to hit before something goes up 100%. So we don't chase things. We don't do the FOMO. We don't buy something because it's in the headline, but you follow the same simple rules. So if I could summarize the rules in a nutshell, look at the stock chart. That's the first thing. Understand the patterns the market moves in, right? So there is an upward movement, there's a consolidation, and then there is a downward for the upward movement. We love to look for that consolidation where a stock is going sideways. The longer, the better, because it means we're shaking out people who want to sell. And you need to shake out the sellers before you can go higher. And to get a little bit more technical and detailed, couple of things we look at. You want to break out above that 50-day moving average line. That's such a key line every trader in the world looks at, I believe. You want to take out the recent resistance. So the recent highs, simply go slightly above that. And it sounds like a lot of charts to watch, and people are like, oh my God, that's overwhelming. How do I do that? Okay, so we go one step back. How do you actually find one of those stocks? You look at the sector first, okay? So we just look at the sectors. We look at the ones that have that very pattern. So right now, we're looking at things like biotech, for example, which have had a terrible year, but are coming around. Then we drill a little bit deeper into the sort of subsectors, which are called industries usually, and you can find them on your website. I'm sure you can probably find the industry charts. And again, you just niche down a little bit, and then you just need to look at the top couple of 2 or 3 stocks in that niche, and you look for the same pattern. Generally speaking, it looks like a heartbeat pattern. It's going sideways. It's breaking out above that 50-day moving average line. It's taken out the recent highs, and I set my buy order just above that. And then if the stars align, you will see at exactly that point, your volume will double or triple or quadruple, and that's institutional money pouring in. So at that point, everybody else saw the same thing that you were looking at, and you'd be surprised how often that happens.
Yeah, I know there are plenty of examples of that happening right now in the market this week, and that is what you have for our viewers today. A list of 5 stocks where institutional money is pouring in right now, making these stocks really primed for a big breakout this week. And the first one is really interesting because it's really more of a sector than even just one stock. So let's get right to that. What is this first sector that you're looking at right now as kind of that pre-breakout stage?
Yeah, so we're looking at home builders. Now, why the heck would you look at home builders? It's not exactly the sexiest industry. It's not exactly AI-driven or anything like that, but it's a very cyclical industry. When interest rates go up, home builders suffer. When interest rates come down, home builders do better. The second thing we have this year, we kicked off the year with tariffs. Everyone is thinking there would be massive tariffs on everything. And that got priced in. I read a statistic the other day. I don't know, the average home would cost an extra $19,000 to build or something. So the market's digested that information and is coming around to the fact that these tariffs are probably not quite as high as initially advertised. So it's coming around. We're expecting a rate cut in September. I think 90% likelihood of that or something, according to the wizards out there. So we like home builders. The story makes sense. If you look at the home builders chart, that story makes sense. It's starting to come around. What then are actually good home builders? Because we want to buy just a couple of best ones here, right? So there are three names that popped up on my screen up. And one is DHI. This is just a stock chart. The yellow line is the 50-day moving average line. It's just a simple moving average line. Always keep everything simple. And you've seen that sort of has turned a corner. So it's bottoming out here. It's coming up. Stock's actually moving up in a pretty nice channel and accelerating that move up, right? We don't have that much resistance overhead. There's just a little bit here from the end of last year. So this kind of wants to go higher. Now, we saw a little bit of institutional buying just after earnings. We saw a little bit of that gap up there. Gap ups are definitely bullish. And when you, after a gap up, you continue higher, to me, that is even more bullish. It's a confirmation. So I think people often look at charts like this and they go, oh, it's too late. But it is actually the stocks that are moving up that are much more likely to keep moving up rather than the other way around. Now, I'm not talking about something that goes up 200% in a day. That's probably a little stretched. But something like this, it's popped up from that real entry point here. We're about 14% higher. That's not massively late, right? So there's probably a little bit of juice in this. And the beautiful thing is, as I say, very little overhead resistance. So there are very few people in this stock who've lost money on it, right? Almost every single person who owns DHI is in the money, and therefore they are very unlikely to sell. So that's one of the things we look at.
Felix, you have a really good analysis of these stocks. I like looking at the chart with you. Let's move on to that next home builder. I know you have a couple other home builder names to get to too.
We have two more, sort of for good measure. Now, why would you want to spread your money across a couple of them? Because there's usually one that outperforms. So I would always open small positions in a couple of them, and then we double down on the actual winners. And we might get out of the ones that are not performing, because lagouts are usually not that great. So what have you got here? Very, very similar situation. You have that earnings call there, which clearly wasn't bad. I haven't read it. I haven't listened to it. I don't need to. I can see that much more money than usual poured into it, which means a lot of people listen to it, and the money tells me what's going on here. So some people would call this a cup sort of a thing. I'm not hugely into patterns of that sort of sort. I literally just look at the same thing. Look, we're above that 50-day moving average line, right? We're moving up very nicely. Volume is decent on a rally, not huge, but decent. And again, we have only a couple of people up here who are down on PHM. So a few of them might sell. So we might see a little bit of this happening, but the likelihood is then that we're going to continue our way upwards as interest rates keep going down and as these tariff deals come in and they're not quite as atrocious as we thought. And then the third one here is TOL. And look at that. It's almost the same pattern, isn't it? It's even got the same hallmark little mini gap up here when its competitors were gapping up. And I already put these trend lines in here. So where would be the sweetest entry point from my point of view? For me, it's always slightly above the recent highs. The recent close price is what I look at. So right there, which is about $132, $133. To me, that would be very, very sweet. Now, if you break out of this whole channel, that would be even more confirmation. And what you're really wanting to look for on that move up, you want to see a nice big green candle up, right? Now watch out for earnings. That's a little bit of a risk factor there, obviously. So it's really just looking at patterns. It's looking at rules. When I first started looking at stock charts, I thought this was just nonsense. Nobody could tell anything from a stock chart. I thought it's just a chart, right? How would it tell you anything? But if you think about it, all the decisions of all the money in the world, of all the money on Wall Street, all the money in hedge funds, is reflected in this. And if you just combine what the price is and how it's moving, the support and resistance points with the volume, you actually know what everybody's thinking. And all we do is we just follow that. We follow the same patterns, we follow the same rules that, the guys on Wall Street understand.
I want to talk about with these home builder stocks, even looking at the chart, looking at the volume happening right now, we know this is where the money is going. We know that rate cut is really behind a lot of this move into the home building sector. This whole sector has been so low, like you said, for almost the whole last year. But now there's this excitement about this rate cut coming. But talk about that potential risk and maybe any warning for investors if you're looking at these stocks right now. Are we seeing all this volume just because this rate cut is expected? Could all of that growth already be priced in? consolidation? Is this a real sign of an actual turnaround in the sector? Just talk about any of those risk factors to think about too.
Well, I think first of all, we're still down 21% since November. So there is still some bad stuff priced in here, which is a factor of tariffs and higher interest rates for longer. There is, of course, a chance the Fed doesn't cut in September. It will have to cut at some point. So whether it's September or November or December doesn't really make a huge difference to me. None of this noise really matters. You're not going to make more money because you're predicting it. Nobody knows what the Fed is going to do. But what we do know is where the money is flowing and what the stock chart pattern is. And also historically, that after a tough time for home builders, there is eventually a recovery. And there is a massive shortage of houses in the US on top of that, which is actually a fact. When I first learned this, and I had some really, really lovely mentors, I still do, I have about 20 of them or something in our academy. And I always ask them stuff, well, what about this news? What about that? What if this happens? And this guy just said that. And they're like, it's noise, ignore it. Just look at the money, and the money is the chart. If it mattered, it would be in the chart. You and I aren't the only people looking at this. There are a lot of people who are smarter, more money, better informed, with all the data at their fingertips, who are moving billions and billions of dollars on the basis of what they think is right. And if you look at this, what have you got? You've got a very, very nice bottom being formed here. You get a very, very, very nice uptrend that is just consistent. And it's that sort of zigzaggedy move, which is exactly what we look for. So all we want is for the stock to break out a little higher. And at that point, it becomes quite a sweet entry. And of course, earnings might be the catalyst for that. But again, we don't know that. It's a coin toss event. So I try not to get distracted by the news. In fact, I think the less news we consume, the better we get at managing our money.
Yeah, basically spend more time looking for headlines in the charts themselves rather than in the news. Love your no-nonsense approach to investing, Felix. This is great advice. I'm excited to move on to the second part of your list. And this is another sector that's really struggled this year, and specifically a stock that has really struggled this year too.
Yeah, so this is a stock that saw its CEO get murdered, that has criminal investigations by the Department of Justice. I mean, just a horror story, right? And cheap is never, ever a reason to buy a stock. And I think if you just tattoo that on your forehead or somewhere where you can see it, that's a really, really good thing. And too many people chase stuff when it's cheap. So I obviously have a YouTube channel, and I got thousands of people were asking UnitedHealth after this gap down here in April. They were like, it's cheap, let's buy it. So if you're a trader and you look at that yellow line there. So by trader, I mean somebody who's got a shorter time horizon. You're not buying things to sort of for the forever horizon. That 50-day moving average line is pretty much your exit line. So when you gap down through the 50-day moving average line, and then on top of that, that line starts to slope downwards, you got to get out. And you wanted to automate that because that morning when you woke up and you were down here, it was very, very hard emotionally to hit the sell button, right? Because you just lost whatever it was, 20% or something that day, right? What did we do? 22%. So very hard to do that. You're always going to sit there and you're going to think, it's going to recover. It'll go up a little bit and then I sell, right? I'm going to go back up to zero and then I sell. And then what happens is that you're not just down 20%, but you are now down 40% and then you're down 55%. And then you hold a little bit, you get exhausted, and you sell down here at minus 60%, which was actually the moment where this started to become interesting again. Stocks move in patterns. Stocks drop much faster than they go up by the way, which is why the automation of that sell is so important. That sideways move here was actually quite a good one because it told us there was some stability, right? There was some base being formed. We dipped a little lower, which is actually a good thing on higher volume because it meant the people who really wanted to sell now finally sold. We've probably shaken most of them out by now, right? And then you move back up and you move back up above that 50-day moving average line. And what do you see? It's actually starting to slope up again, that little yellow line there. And it's doing that on enormous volume. I mean, a normal day, it's 10 million shares traded. It pops up on 68 million shares traded. When I was looking at this, I was saying to people, if you're a trader, and literally there's a video on this from like last Thursday, if you want to fact check me. I said, if it moves above that 50-day moving average line, from a trader point of view, it could be a buy, but it's sort of a risky proposition because there was still all these gap downs here and so on. And that's, of course, the next day, Buffett came out and they announced that they had bought the stock. So it pops up, but it doesn't really matter why it pops up. It's just the pattern was the consolidation pattern that we look for, but we don't buy down here I actually bought on that day at, I can't remember what it was, $299. It's not for the love of the stock. It's not for the love of the new CEO and the turnaround story or any of that, because you can pray and hope and wish that CEOs are competent and will deliver, but you don't know that. So I prefer not to hitch my wagon to somebody like that. I just hitch my wagon to where the money is going. And at the moment, the money is pouring into UnitedHealth. So we shall hold it. Hopefully what happens is that this thing goes up a lot higher, and then eventually it'll consolidate sideways. It'll start to go down again, and then we're going to sell it here. A little cold-blooded, but that's what it's about.
No, that's a very just cut and dry way to look at this stock instead of following the headlines of what's happening with UnitedHealth. And we follow a little bit of everything on this at MarketBeat. You can find those headlines in the news that can also impact the stock. We have the latest news on all stocks on MarketBeat, easy to find on each stock you go to. But we also have a lot of this cut and dry data, the numbers that investors are looking for to really analyze what's happening in a stock. If we just make it easy with the free tools that we have. So if you're looking for what institutions are buying right now and how much they're spending, that's right on each individual stock page. So United Healthcare, you can see exactly which institutions bought, how much they bought, and kind of what those trends are. There's all kinds of information like this on our website that's free for investors who are looking for, just like you said, Felix, that cut and dry data to just follow the money. We're making it easy to do that. So MarketBeat has a little bit of everything. We also have a new tool for this next sector that we're about to dive into, and that's biotech. There's even more stuff to follow in biotech because there's FDA approvals, there's new drug progress reports and things like that. Well, we track all of it on MarketBeat to make it easy for investors. So I'm excited to dive into this sector, Felix, because it's been such a poor performer this year. This whole sector's been down quite a bit this year, but the stock you're about to share actually has a lot of institutional interest happening right now. Why is that?
Yeah, so I think, again, first of all, look at the sector, right? So look at a biotech ETF or something. You can look at that as a sector or an actual sector chart, and you'll see that biotech has underperformed. It's had a miserable year. Why? These stocks are very risky, right? Most of them have no revenue and they're spending lots of money and they're hoping somebody at the FDA is going to like them. It's not a sector I would invest in for the long term, but high interest rates also punish these kind of high-risk growth stocks. Basically, every 1% interest rate cut gives you about a 10% boost in the stock price, more or less. So your interest rates go up 5%, you're losing half your money. So it's a cyclical play. And that applies to not just biotech, but anything sort of pre-profit, high-risk kind of stuff. At the moment, it's starting to come around. And I could give you a great long list of lots of biotech stocks, but here is one that is actually kind of ripe for the picking of where I'm sitting. And of course, always, if you're watching this, come to your own conclusion, do your own research and so on. But what we see is what I referred to as a heartbeat pattern earlier. Literally, if you just draw a sort of rough line across those three tops, and it's never going to be perfect, but that's okay. And then you're looking at that and you're going, well, when it pops above that, that's the moment we want to buy it. And it has popped above it, right? It has actually broken out. Now, the only disappointment is that so far, Wall Street has not bought it because there's no volume, right? We want one of these candles in green, ideally. It's one that I'm watching very closely. And it might well be that we need to take out these highs from over here, which means we need to go another, $5 higher or something like that for Wall Street to pull the trigger. Because this is a pattern that's pretty obvious. Everyone's watching the same rules. So again, it just comes down to belief in the company or the product or the drug or whatever they're making, because it's all very high risk. And most of us are not pharma or biotech specialists. It's simply a question of, is the money buying this?
But with so many stocks in this sector really booming right now, and a lot of them seeing a lot of institutional buying happening right now, how did you narrow down your list to just 2 stocks in the tech sector?
Of course, you can just go and buy NVIDIA. But the challenge with something like NVIDIA is it's a $3 or $4 trillion stock. For that to double, you need quite a lot of money. So it's harder for a stock that size to, double or triple. We've therefore been buying smaller stocks that are still in that sector. So ANET, essentially sort of infrastructure for data centers type stuff. Terribly boring. It doesn't really matter what they do in a sense, but you can see always multiple entry points. So you see down here, your 50-day moving average line bottoms out, right? You then get that sort of sideways thing. And arguably, somewhere here was a great entry point. The money was popping up a little bit down here, right? You then get a nice little rally up, You get a nice gap up here. Again, the money was following. And what are we doing right now? Well, we're doing the same thing. We're consolidating sideways. So all we want to do is take out these recent highs here, and we will get entry point, not number 1, not number 2, but we will get entry point number 3. What I tend to do is buy the same winning stocks again and again. So we just wait for the next breakout and we buy it at a little bit of a higher price, and the beautiful thing with where we are right now, we've also taken out these February highs. So again, there is nobody in ANET in the world, basically, who is down on this stock. So the selling pressure is almost zero. Why are you selling something that's making you money, right? So very few people do that. Look a little bit beyond the main guys. If you are quite far run up, there are sort of certain laggards, and I think ANET is one of those, and it's also a very good business. So yeah, it's one of the ones I like.
It's a really good one and not one we've talked about much on our channel, so thanks for bringing that one to the table. This next one is one we have talked about quite a bit, and it is one of those more popular names in tech. So I'm curious to hear why now? What is the chart saying that now is a time to get into this really big tech name?
The next one it's AMD. It's not exactly a secret stock here, but it's one that, again, moves in the same predictable patterns, right? So we had a consolidation over here. We then broke out massively. You get a consolidation at the top, and that was your exit point up there. You see where it broke below that 50-day moving average line? That was your sell. And then it just collapsed and collapsed and collapsed and collapsed. And a lot of people were, well, they were losing a lot of money on that, right? That thing went down 50, 60, 70%. And I just have to move this kitten out of the way. Otherwise, she's going to eat my mouse cable.
And that is why your channel is Felix and Friends, right? The friends are the animals.
Yeah, we've got an adopted golden retriever and about 9 adopted cats in here. It's a complete zoo. But they're very good at stock picking. Yeah, so if you just look at that whole run down, people were saying to me every day, I'm buying it because it's cheap. And I'm like, I'm not buying it. I'm not buying it until it turns around. This was not the buy. That was the bottom of the market, but you didn't know it was the bottom of the market. What you were actually doing is you were buying a falling knife that could have gone a lot lower. If you were really, really risk loving, it would have been somewhere here. You can see my entry point was 119, so we bought it here. Why that? Because we took out the recent highs, we'd gapped up quite a bit, and we'd pulled back and then retested those highs, we've broken through them, and that was a pretty decent entry point. So for me, it's not about buying it cheap. For me, it's buying it with the lowest risk. And then what does the stock do? Well, like any good stock, it zigzags, right? So it does this sort of lovely pattern here, which means it gives you lots of buy opportunities. So it's never too late. The AI story is still running. Morgan Stanley says, I think $3 trillion will be spent on chips, and AMD will get some of that. Whether they get a lot of it or little of it, I don't know. I don't really care. All I really care about is that we're in an uptrend, right? So we're in a very, very clear uptrend. Every low that we hit is higher than the previous one. The highs are always higher than the previous one. So you could, 2 approaches. If you like a little bit more risk, you buy it on the pullbacks and the bounce offs, sort of here. If you want less risk, you buy it when it exceeds the previous high. My opinion, you got to come to your own conclusion on these things. I'm not telling you to buy it, but it's the same rules-based system that Wall Street and Chicago has been using for 50 years. One of the reasons it works is because everybody's looking for the same data points. So it's a lot less esoteric. It's a lot less, do we like the product? Is the latest chip faster or cheaper or any of that stuff? You can't really judge. It's just, where's the money going? Here you have a very, very, very nice uptrend, and you've got some pretty decent volume here, right? It's a pretty decent volume compared to where we previously were. And that's really all it's about. And I tell you what, when this rally continues and the volume starts to fizzle out, that's your early warning sign. Tighten your stops.
Really great advice for viewers today to just follow the money and ignore all of the headlines and all of the noise around these companies. It's a great different way and different perspective of looking at the market that I love sharing with viewers. We love to have all kinds of different guests on the channel, and it gives so many different perspectives on how to look at investing. So Felix, thank you for coming on and sharing your perspective on investing and what's worked for you over the years. I know this is something you share with a lot of your viewers and through Goat Academy too.
Thank you so much, Bridget. I really appreciate you having me on. It's an absolute pleasure. And just my whole passion is just to share this information. We don't lock it up. We don't hide it. It's just out there every single day. And you have to just find a system, a pattern for you that works as an investor. And there isn't a right or a wrong. For me, it was just a question of what can I do that takes the least amount of time. So for me, this takes about 2 or 3 hours a week. And that's amazing because I have the rest of the week to myself. So look at what other people have done. That's all I would say. Look at what people have been doing for decades and follow the money.
Right. If it's worked for countless other investors for decades, it could certainly work for you too. A great outlook, Felix. Thank you again for sharing your unique perspective on investing with our viewers today. Let us know what you think in the comments. I'd love to hear your thoughts on the specific 5 or really 8 stocks that Felix talked about today. But I'd also love to hear your thoughts on the concept of just following the money and ignoring all of the noise when it comes to investing. What do you think of this approach? Do you have a different approach? I'd love to hear from you in the comments. Thanks again for watching, everyone. And as always, happy investing.